An important market voice, Ashish Somaiya, Managing Director and CEO at Motilal Oswal Asset Management, joins us right now in our studios. Ashish, so good having you. Thanks much for taking the time out.
Thank you.
How difficult is it right now to tell all your subscribers or all your clients and meetings that you address about what the markets could do in the near term? Because frankly, almost every single day, we're seeing volatility which is very high, but the levels not moving around too much.
I think if you're part of the markets, I'm going to share something with you which is not necessarily directly to do with the stock market itself. But what I've realized is that there are times when things are really bullish. And when things are really bullish, everybody thinks in very, very macro generalistic terms. At that time, I find it important to bring our clients to the details. And there are times like this when people lose sight of the big picture, they lose sight of the macro, they lose sight of the general long term, and they get overly focused on the micro. So I think this is more a question of perspective. When things are looking, I'll give you an example. Now you look at what is happening with auto. When things are booming, everybody says that, the auto story actually starts with $4,000 per capita. We have a long way to go. And there are times like this when people say that, if you add up all the two-wheelers and all the four-wheelers, and if you add up the number of people who can afford them and the number of families, I think we're pretty much penetrated. What is left? So I think this is a question of keeping the right perspective and not getting overly focused on here and now. That's the point.
So if you are not overly focused on the here and now, but looking at the long picture, which is largely higher, what is it that you have been doing in your schemes? I also want to talk about, by the way, a couple of new launches or a spate of new launches that you're planning to do. You were pretty active on Twitter about it. I would want to talk about it. But first, within your existing portfolios, Ashish, where has been the bent of the large spate of asset managers that you have? What is it that they're trying to do within the schemes? Where is it that they're going overweight? Where is it that they're going underweight?
No, I think when it comes to us, frankly speaking, if you ask me in the last 6 to 9 months, the kind of deep slowdown that you're seeing with auto, we don't have exposure to, say, FMCGs and consumer, really speaking. Never had that much exposure really in the last couple of years. But if I speak about the auto part of it, then yes, there are a couple of exposures in the auto segment, and the kind of deep cut that has come in has definitely taken not only us but taken a lot of people by surprise. Now our understanding is that this is not structural, so we are definitely going to live through this, and we are pretty sure that eventually investors also will make good out of it. There's no harm in living through this near term. It's just that when there are some cyclical headwinds, like very long-drawn election season, and of course we know what is happening with lending and NBFCs and stuff, the general business environment level of confidence has been slipping in the last few months. So I think those are cyclical in nature, and my senses will be out of it. So we are living through that. But as far as the other sectors are concerned, I think if you see at our end, there are not many dramatic shifts in the sectoral exposures. Okay. So if you see private sector banks, one thing where we are way away from the index is, for example, we've had high exposure to insurance for quite some time now, and that still stays. No change out there. So private sector banks, we never had very large exposure to NBFC, barring a couple of them. So that still stays as it is. So honestly, not many big changes.
You haven't gone out and made radical changes to your portfolio because of what's happened in the market in the near term?
Yeah, because our belief is, that's not our style, really, if you ask me. To react to near-term developments is not what we do. There are times when we think that, companies will, even the best of companies will go through a couple of bad quarters. I think we have to convince ourselves that their franchise is intact, and if the cyclical parameters are behind us, then will they get back to their winning ways or not? That's a true test of the franchise being intact. So as long as we are convinced, we are not going to react to what happens in a quarter or two.
Interesting. Let's speak about some of these pockets. Now, insurance, we just filed a story, I think, or we're putting out the story today about how the AP growth for a large slate of insurance companies has been the highest in the last 22 quarters or something like that, 22 months or 22 quarters or something like that. Now, there's a constant debate about whether this industry is under-penetrated or over-penetrated, because a lot of people cite the number of houses which already have insurance. And because of the low per capita, how many of the other ones which do not have penetration will anyways think about taking insurance as well in the first place? Where are you guys on this argument? Or is the call on insurance not a factor of penetration but of some other reasons?
So there are multiple things. If you ask me, one is, on the first point on penetration, I personally find it hard to believe that we are right up there kind of thing, because a lot of times people say these things in terms of the number of people who are eligible to take a policy versus how many number of policies are out there.
Yeah.
I think that's the often quoted number. But the fact is that, you ask somebody what level of insurance they own, what's the materiality or what's the calculation behind the insurance that they're taking. And my guess is, unfortunately, India is a country where people buy insurance to save tax, and they're not buying it for the core purpose, right? So I think that is a measure of underpenetration, where people are underinsured, and people don't have a sense of how much they actually need. So that is one thing. Second part is that, if you think that so many, the loan growth, let's say, mortgages, consumer loans, car loans. So how can it be that consistently keeps rising, but people don't feel the need to actually increase their insurance? Also, how many people, even people like you and me, our friends, if we were to actually calculate, they how much do you earn and what is your level of insurance? I find my own friends are underinsured. So I think the awareness is pretty much not there, and that is because people buy insurance to save tax, not for any other reason. Coming to the second point, I think that insurance companies are, their business kind of seasons over a number of years, right? And we have to keep an eye on how the EV is actually progressing over the number of years, what kind of track record they have, etc. The other important thing to keep in mind is that insurance is a business where brand matters most. Otherwise, how do you explain it that for the same policy, for the same cover, there are companies with some 40% kind of higher premium?
Sure.
Right? So there are multiple. It doesn't get evaluated with these traditional valuation parameters. I think there are multiple drivers to it. Also, what I should keep in mind is that people like us, whatever I say, take it with a pinch of salt, because that we hold stocks for 4 or 5 years, irrespective of even if our couple of quarters performance goes bad, we still stick it out and we hold on. But a lot of people in the market have a 1 quarter forward or a 1 year forward perspective. So I think that needs to be kept in mind.
Okay, put in points. The other conversation, aside of course, autos and insurance, which you must be owning, is what's happening to select pockets which look like turning around. Now, I've heard from a lot of your peers in the asset management industry about how telecom now seems to be looking ripe for a bit of a pullback. Do you guys have any view there? Do you personally have any view about what could happen to telecom?
So first is that it's unlike us to fish in troubled waters.
Okay.
So it doesn't suit our way of working. For example, the first time we took exposure to corporate sector banks was after some of these governance issues were behind, and we could see that there are early signs of improvement. So we don't mind losing the first 10-15% or even the first 20%, and we don't mind entering after we can see that there is a runway out there, right? So we are actually not the kind of guys who would fish in troubled waters. That's the limited point, I will say. And from that perspective, I think we have a lot to see. The other is we'll not get into businesses which very, very high leverage, right? Because a couple of bad quarters and everything can just, all the rosiness can just evaporate. So I would just leave it at that. I would say it's not our style. But I think people who do believe that there is deep value out there, maybe they might want to take a plunge.
Okay.
That I don't disagree with, actually, if you ask me.
Yeah, I mean, it's a different style for different people, and I think whatever suits whoever is the kind of call that they will make. Ashish, what's the view that you have on the stocks that get impacted from a global trade perspective? Now, we've seen different treatment meted out to different companies. The more defensive bent information technology has rather held out well amidst this whole US-China trade spat, though it probably doesn't get impacted that directly.
Yeah.
But autos, for example, Tata Motors, Motherson Sumi, and their whole pack has literally gotten butchered in the last 1 month.
Yeah.
What happens next? Because this doesn't seem like ending with Trump's recent move on Huawei. It doesn't seem like they want to scale it down immediately.
I think that there is escalation, and there is, brinksmanship or one-upmanship which is at play out there. The unfortunate part is that, for example, during our younger days, we all have seen these WTO negotiations and so many things we've been through. I think the difference was there at that time there was no social media and there was no communication actually which came out. And now I think the challenge is that while pretty much what might have been happening 15-20 years back, maybe this is exactly what was happening back then also. But I think now the level of information is so high that literally every part of the negotiation is being put out in public. So I think that that causes more turbulence according to me. But apart from that, I think it's too early to make a call on this. I mean, fortunately or unfortunately, whichever way you see, we don't have any of those exposures in our portfolios. But I think these are things which will take 3, 4, 5 years to really play out. Because there is a realignment of supply chains. Clearly for some companies there will be a deep psychological impact of how it plays out for you when you operate in certain jurisdictions or certain geographies, right? So I think for them these are very, very big changes, and I think it will take 3, 4, 5. I don't think that people should just jump in because they think that there is some realignment happening. We don't know the final shape of these things to come. So it's best to stay out of anything which you think is remotely in the eye of the storm.
Okay.
And no early conclusions to be made, honestly.
No early conclusions. Okay. One final question, Ashish, before we let you go. This whole spate of challenges that have cropped in the NBFC space, you reckon they'll die down soon? I mean, is liquidity the primary concern? And if that suffices, will we see sanity prevail soon?
I think I used to really think a couple of months back that, and I was wrong at that time, it looks like. I used to think a couple of months back that, the worst is kind of behind us. But, you are again seeing these issues cropping up. And my fear is that what started as a liquidity issue, when something, in this whole thing, it always starts as a liquidity issue and then it boils down and then it kind of spreads further into credit and other solvency related challenges. So my sense is that a lot of damage has been done, unfortunately, right? And the powers that be need to really kind of look at this, once this election is out of the way, at least there is a perception that, we need the election to be out of the way and then we need somebody to really roll up the sleeves and look at the situation. So I just hope that it's handled well and it doesn't blow out into something big. But my fear is that yes, there is some damage which has been done, and people are really fearful of the segment.
Well, maybe again, troubled waters might help not to go out and fish unless you know the waters very, very well. But Ashish Somaiya, take a moment to thank you for joining in today.
Thank you
on
for
such
having
short
me.
notice. Really appreciate.
Thank you for having me.
Yeah, pleasure. Pleasure is entirely ours. Take a break on that note. Coming up, we try and decode earnings. Fourth quarter numbers of KPIT Technologies. Kishore Patil joins up immediately. And even amongst the consumption slowdown, India's trade deficit widens in April. We talk to D.K. Joshi of CRISIL about the same.